All right, guys, welcome back to the buyingrealestateblog.com. I'm Jason Fleming with Keller Williams Realty and Group 4610, and this is Patrick Richie. Patrick is the author of The Credit Roadmap. He is also a GRI instructor of finance for the Arizona Association of Realtors. The reason that I brought Patrick in today is because he understands credit like few people that I've met. And there's a lot of my clients out there, a lot of people that I talk to that have a lot of ideas in their mind about credit and how does one thing affect you versus another. And so we want to talk to Patrick about a few of those things. So Patrick, for example, I spoke with somebody earlier who was asking me, well, is there a difference between like a medical claim on your credit versus a credit card claim? Maybe talk to us a little bit about some of the smaller things. I don't know if I want to call it smaller things, but things that aren't having to do with like your mortgage and your car payment.
Yeah, and keep this in mind. I mean, anything, if I have a medical collection on my credit report or a utility collection or a library book collection or whatever type of collection it may be, versus say a credit card charge-off. What a charge-off is just an accounting notation that says generally a credit card charges off, you would see it at 180 days, and so it means I haven't made payment in 180 days. The credit card company is now turning it over to collections, taking it off of their books. I still owe it, it's going to show up as a collection. All of these collections, no matter where they stem from, pretty much are all equal in terms of, no matter what the amounts are, what they stem from, stuff of that nature, in terms of how it's going to affect the credit score. It's a serious derogatory thing. So from the standpoint where there could be a difference isn't so much in the credit scoring as much as if somebody was applying for an FHA mortgage, there is less severity to a medical collection. And here's why. Let's say that I'm driving along and somebody crashes into me and they don't have any insurance and they've sent me now I've got to go to the hospital and I incur $50,000 in medical expenses because of broken bones and this and that. My insurance doesn't cover everything. So I end up with thousands of dollars in medical collections. That's common. That's happens a lot, and so from that standpoint, it's different than me from an underwriting standpoint. That's different than me going out, getting a credit card, using it, and then all of a sudden not paying for it.
Sure.
So you got two different scenarios. Does the credit report look at it that way? No, it doesn't. But do guidelines in terms of underwriting sometimes consider that? Can I explain? Here's where this
Sure.
came from. So there's a difference between how the credit report would look at it and how an underwriter may look at it, especially how you would see it with an FHA mortgage. Assuming that I have good enough credit to get, because generally, keep in mind, if I have less than a 620 credit score, it may not matter anyway. So it may not matter. So from that standpoint, generally, as far as how the credit report would treat it, they're pretty much going to be the same. They both will come off after 7 years. Once that credit card has charged off and goes to collection, it's got a 7-year limit, just like any other collection would have a 7-year limit. So once again, it's important for me to hold on to copies of my credit report because I don't want that stuff. I need to know that those collections are going to be transferred to other collection agencies at some point in time. If whoever has it today doesn't collect on it, it may transfer every 12 months, maybe every 24 months. But keep in mind, collections always have some sort of a value. So here's an example. Let's say that I have a Chapter 7 bankruptcy. And the Chapter 7 bankruptcy, that's a full discharge of the debt. So it discharges, I no longer am legally obligated to anything. So you would think that there would be no reason that a collection agency would want Chapter 7 discharge debt because they legally can't collect it. However, there is still a value to Chapter 7 discharge debt of approximately a third of a penny on the dollar. And so it's very, very low. So I could buy a ton of Chapter 7 discharge debt and just see what I can get people to pay, because there's 3 ways to get people to pay. I can sue them judicially, but then it comes with a lot of procedures and rules and limitations and costs. Or the easiest way, then the most utilized way, is to just throw stuff on the credit report. That's why the credit reporting industry exists. It's a easy means to try to get somebody to pay you back because of the fact that, well, it follows it. If everybody's using it before extending credit or to rent to somebody, as a landlord, I'm always going to look at somebody's credit report. I'm not going to rent to somebody who has previous judgments from their last landlord, because they say about tenants, when your tenants become part of your family, their problems are your problems. They lose their job, it affects you. So there's so many things that the credit report is used for. So it does carry a lot of weight. And so even though nothing is forever on there, they know that they can influence people to pay as a result of what it may cost. Or in the case of the Chapter 7 discharge debt, which can't be sued on, can't be reported on the credit report outside of the actual bankruptcy itself. In Chapter 7 bankruptcy stays on there for 10 years. Most other things stay on there for only 7 years. But from that standpoint, they're just maybe going to call me, or they're going to send me a letter and use this approach of, well, we would hate to ruin everything that you have done in terms of rebuilding your credit after bankruptcy, stuff of that nature. So people need to be aware that there's always value to collections. And if a collection agency were to change the date on the collection, on how it's reporting on my credit report, well, they've increased the value of that collection potentially. And so as a result, maybe there's cause, maybe there's motivation there for them to do that, and it's happened. I mean, you can read about it on the FTC website. And so that, I just want to be prepared for. I want to know that if I'm dealing with collections, they can become problematic. So definitely.
So once again, important reason to hold on to an old copy of your credit report, because you want to be able to go back and show, look, this was on this date and it wasn't, this was from 2000, not 2008. And you've got your credit reports there to be able to prove that. So the $1 million question here, what's the fastest way to build your credit back up and recover from some of those things that may have hit your credit?
Well, the fastest way is to generally have the money to resolve everything.
Pay it off.
Or to settle. And so from that standpoint, in the absence of that, it's just going to be time. But let's say that I do have the money, or I am able to sell, whatever the case may be. The next thing is going to be me going and looking at my credit report to make sure that it's reflecting that I've paid this stuff. Because probably 9 times out of 10, if I realized I had a collection, let's say it's a $100 collection from anywhere, and so I realize it, and I say, oh gosh, if I would have just known that, I would have just paid it in the beginning anyway. I wouldn't have wanted it. I wouldn't have let it go to collection. I pay it. Well, I guarantee you, 9 times out of 10, 6 months later, after I pay it, that same collection is going to show up in my credit report again. After I pay it, they are not going to go back and remove it. So this is probably the #1 most common inaccuracy that you're going to see on a credit report, is the collection that's reflecting as being unpaid, that still shows as being past due, when in fact it has been paid. Because the burden of discovery is on the consumer to find and discover this stuff, and then basically go ahead and go through the disputing process to contact the credit bureaus and say, this has been taken care of, providing any documentation they may have. Just a very basic letter that you just mail out to the credit bureaus. And keep in mind, you can dispute on annualcreditreport.com, that government mandated website where consumers can get their free credit report. But keep in mind, annualcreditreport.com, if I were to dispute through them, I will probably have less luck than if I just did it by mail. The system does not seem to work very well. And there's various reasons, but just know that if I have my choice between the two, if it were me, I would do it by mail. I probably would not even bother doing it online through annualcreditreport.com, just for the fact that people seem to have more success doing it by mail. But just keep that in mind. Just don't make assumptions. When it comes to credit, don't make assumptions. Here's another thing. Let's say that, because I know that I want to keep my credit utilization on my credit cards as low as possible. So let's say that I have a $10,000 available limit on a credit card, and I have a $1,000 balance. Well, 10% credit utilization ratio, so that's good. I'm in good shape. But what if I haven't actually looked at, what if I'm saying I have a $10,000 available credit limit based on my credit card statement, but I haven't verified that on my credit report? And I see this happen to a lot of people, where they make these assumptions. And so when I'm looking at my credit report, I want to see what is my reported credit limit, because what if they're not reporting a credit limit? And this happens. And so if they're not reporting a credit limit, then it's going to show the highest balance I've ever had for the life of that account. So let's say in that scenario, I have a limit of $10,000, it's not reporting, but the highest I've ever had a balance of was $2,000. So I have a current balance of 1,000. My highest balance ever has been 2,000. Doesn't show my actual limit. So then the credit utilization ratio is going to be based on my highest balance ever. So now all of a sudden I'm at 50%, which is higher than 10%, which isn't still bad. But let's say that I was at a balance of 900 and my highest balance ever was 1,000. Well, now all of a sudden I've got a 90% credit utilization ratio. So it's very important that I know what is on my credit report, so I can kind of keep track of these ratios and just kind of know, okay, if I need to get my credit score up, I know I need to bring the ratio down. So, yep,
got it.
That's it.
Excellent, cool. Well, thank you so much for joining us
No
today. If you guys out there are wondering, or if you need some help getting your credit repaired, I'm going to go ahead and put Patrick's information on just below this video here. Once again, he does have his book out, The Credit Roadmap, that you can get on Amazon.com. Go ahead and check that out. For those of you guys that are looking at buying a home or selling a home, I've got a book that I'd like to get into your hands. We're giving away actually one of two books. It's your choice. The first book that we're giving away is called Your First Home, and then the second one is The Millionaire Real Estate Investor. Both of these books are fantastic books. They're written by Gary Keller, who is the founder of Keller Williams Realty. He's also a New York Times bestselling author. And if you guys are interested, I'd like to get those in your hands. Give me a call or send me an email today. My contact information is going to be just below this video here. Thanks for stopping in again, and we look forward to seeing you again soon.